I'm Katrina Scott, Chief Investment Officer at Mariner Wealth Advisors, and I'm here with my close colleague and Chief Investment Strategist at our firm, Jeff Krumpelman. Jeff, as always, great to be with you. Jeff and I want to provide a recap of the challenging first half of 2020 that has been accented by the coronavirus spread, which is ongoing, and then most importantly, to provide you with our outlook for the markets for the rest of the year and into 2021. While we've come to know that change is a constant in the markets, this has undoubtedly been one of the more unique periods in market history, one that has been tumultuous to investors at moments and that has caused much angst in the people of this country and people throughout the world. And yet, we remain not far from the S&P 500 highs set back in mid-February. Despite some violent swings, all seems well if focusing on the levels of the U.S. stock market at the halfway point of the year. The economy is in transition, we think in a positive fashion, but what does this mean for the markets and investors for the balance of 2020? That's really what we're here to discuss with you today. Before I bring Jeff into the conversation, though, I'd like to highlight just a couple more items to best set the table for some dialogue that we hope that you'll find helpful during these uncertain times. In terms of a little more background on market behavior and the results so far this year, the first 6 months of 2020 is obviously behind us, and what a roller coaster first half it was. After suffering its worst first quarter performance since 1938 in Q1, the S&P 500 went on to generate its best quarterly return since 1998, advancing over 20% for the second quarter of this year. The first half of 2020 also marked the period in which the National Bureau of Economic Research officially announced that the U.S. economy entered into a recession beginning in February, calling an end to the longest economic expansion on record, 128 months. Never mind that this was a forced economic shutdown, not a normal business cycle disaster, and that it could be the shortest-lived recession in our history. In our view, the negatively slanted headlines and predictions of complete market meltdown being advertised back in March were far too premature and misrepresented what was actually happening. All the damage to the market that was done in a very concentrated 3-week period in the February to March timeframe, during which the S&P 500 experienced a 34% peak to trough decline. Headlines at that moment pronounced this to be a definitive bear market and caution investors to run from stocks. We counsel clients to be calm and patient. Unlike prior pullbacks in which we tended to be very bullish and advised possibly buying on the dip. However, this time we suggested simply holding your ground in equities and upgrading holdings as we found certain securities to be overly punished and throw the baby out with the bathwater style, while others were more deserved of sell-off and likely to face continued challenge. We were cautious on a near-term basis and respected the uncertainties of the significant unknowns around COVID-19, but we remain quite positive on equities in the longer term. We have maintained our 3,500 target for the S&P 500, but just pushed it out to the mid-2021 timeframe versus our pre-coronavirus view that the S&P 500 would reach that level by calendar year end 2020. So this is only a very modest adjustment in timeline. Our optimism was and is based on the equally unprecedented levels of monetary and fiscal stimulus, knowledge that the economy was in good shape and not on life support going into this health scare, that we were social distancing and shutting down to bend the curve, and that novel efforts to introduce therapies and vaccines were well underway. We felt the worst of the challenge would occur in the second quarter, and we would begin transitioning to less worse activities in the second half of the year, and then to stable and perhaps good in 2021. And we felt the market would sniff out this transition ahead of it happening. We're glad we maintained this hold your ground view. Our main point has consistently been to avoid whiplash and head fakes in the coronavirus period. The horrible return in the S&P 500 during the first quarter was quickly followed by the best 2-month stretch for the S&P 500 since 2009 during April and May, and one of the best first phase recovery rallies on record from March 23, 2020 through the end of June, up more than 35% off the bottom. Regarding risk of whiplash, if you would have sold in March in the face of all the negative headlines, it would have cost you dearly and you would have missed the rally. The bottom line is that we are pleased with our hold your ground theme and adage not to mistake activity for progress at times of stress and frankly in general. So Jeff, as you like to often say, some California chill has felt like the right side of valor here to us. With that, I'd like to turn to you and ask you to provide an update on our base case outlook and just jump right into things.
Sure, Katrina. Well, first of all, I guess I'm just going to pile on here after that introduction that you just made, pretty comprehensive introduction, and say that, I just so much agree with your main point of seeing no need to take dramatic action and make huge shifts in allocation back in the first quarter when the market began to sell off. We just felt that the economy was going into the coronavirus challenge in pretty good shape, and that fiscal and monetary action would be swift, it'd be significant, and that therefore the coronavirus kind of challenge, the economic challenge emanating from it, would be transitory. And this is what kept us in stocks. We saw the government and the Fed doing a lot, and just the economy being in good shape going into it. But at the same time, we felt that the health-related COVID-19 risks were great, pretty uncertain as to how they would be managed, and enough so that it was premature to buy on the dips. And that was counter to previous pullbacks going all the way back to 2009, where we were more inclined to say, hey, let's buy on the dips. So we were more patient this time, and hence came our hold your ground and avoid whiplash view that we champion. And as Charlie Munger says, sometimes successful investing is just sitting on your arse. And as the key partner with Warren Buffett, I think that's pretty sage wisdom there. We did make some tactical adjustments. That doesn't mean that it's just status quo buy and hold at times like this. We did make some tactical adjustments and tweaks, but we refrained from major rebalancing or implementing major asset allocation shifts. And that kind of philosophy here, or strategy, has worked well. And after all, the market is only off 3% through mid-year 2020. It's up close to 7.5% positive return for the past 12 months ending in June. And, I don't know about you all, but that just doesn't sound like a deep, dark bear market to us, one that requires and invites major portfolio restructuring. So, I agree with your introduction pretty passionately. And why don't we turn to the first slide here, turn our attention to that, and just get straight into it with regard to our S&P 500 target, looking out over the next 12 months. And you can see that we maintain our earlier target that we introduced for 12 months of 3,350 to 3,500 by mid-year 2021. This represents roughly a 10 to 15% upside advance from the 3,100 price level as of June 30th, 2020. And we assign a 60% probability that we see these healthy results. And it's really just based on very moderate earnings growth outcomes that we find quite achievable. Specifically, it assumes that we see S&P 500 earnings of 180 per share by 2022, which is simply the number that we had expected to see by calendar year 2020 before the coronavirus challenge really surfaced. And earnings expectations have indeed bottomed. After coronavirus happened, earnings expectations were coming in and down, in other words, and they've bottomed and they've finally begun to rise and come back up for what people and experts expect to see for earnings at the end of this year in 2020 and for next year, kind of in a Nike swoosh type of pattern. Not major revision, but stable and positive revision. And that's what you want to see. And in fact, should evidence surface that it looks like COVID-19 daily cases do begin to ebb, and we've gotten some pretty good news on vaccine technology and development just in the this past week, we are very likely to increase that 12-month target. But we think it's premature to do that at this time because there is enough uncertainty that is still lingering out there. Now, we have a couple of other cases that aren't so rosy. We have a disappointing and a pessimistic case where we simply recognize that earnings recovery may be a bit lighter than we anticipate. In the disappointing case, which provides very modest downside that we could see if confidence is shaken just a bit. And then we do see some double-digit negative potential in kind of a worst case outcome. We think the bottom has already been marked, but we could approach the previous bottom if we don't have good news on vaccine and other drug therapy to treat, if cases spread, and if we don't get the follow-on stimulus that we expect in our base case. So, we want to watch for this and we want to monitor it. And that's why we're a little cautious on the near term before we say we're out of the woods. And yet longer term, because of the stimulus, because of the improvement in the economy, the improvement in earnings, we do think that we're going to see nice double-digit returns over the next 12 months.
Thanks, Jeff. So basically, we just tightened up our target range for the S&P 500 a bit. And that is, we really just kept the upside we established several months ago, but have increased the downside or brought up the expected floor level, recognizing that the aggressive Fed and fiscal policy is helping us to get us through the Q2 soft patch, and the economy is trending in a much better fashion in Q3, though we aren't necessarily out of the woods. So, Jeff, how about updated thoughts on coronavirus itself and how that's impacting things?
Sure, we're getting news updates pretty regularly as it does look like these daily cases are advancing. And that's what you see in this chart in front of you, that the number of daily cases, that red line, you see the slope is positive. So it started to rise again. And I think that what you have is, if you look at the detail, the two line graphs on the left and the right on the bottom portion of this slide shows that you kind of have a tale of two cities view here, where some of the eastern cities, the larger cities, New York, New Jersey, and other states there, the cities there, cases actually continue to come down. They've kind of been through this first wave and things are ebbing. However, you're starting to see, we would argue, still kind of first phase. If you look at California, Texas, and some of these other states and cities there, the cases are starting to increase. Now, the question is, what impact is this going to have, and are we going to be able to manage this and get it under control? We do think that we're much better able to cope with the disease than we were in the initial stages. While capacity utilization in hospitals has gotten a little tighter, we still think that there's greater capacity and experience in treating these patients. Equipment is more readily available. We know more about existing and potential drugs, what works, what doesn't work. And we see progress on the vaccine and antibody front that could be very significant. So we don't think that massive shutdown is extremely likely. And that said, we're going to continue to monitor this closely. So, we think that there's uncertainty, but we do think that this is manageable and will not result in massive lingering shutdown here.
That makes sense. So while we know that coronavirus is still a key concern, shifting gears a little bit, surveys actually say at this juncture that the election and moving into, the election timeframe presents a risk to the market that is equally probably front and center in investors' minds at this juncture. So can you address our thoughts on election risk, Jeff?
I sure can, Katrina. And it's interesting that you say that, this is one of the major wall of worry items. And actually, in some of the surveys I've seen, believe it or not, election concerns and angst around the election is ranked higher by investors than even COVID-19. So it's on investors' minds for sure. And the angst around this is part of the reason that we're cautious over the next 2 to 5 months in our short-term view, as opposed to obviously our longer-term optimism. And a couple points I would make before we, really look at some of these line graphs on what's going on. First of all, the market just tends to stall a bit every election cycle. 3 to 6 months before the election, people just begin to worry about potential policy change, speculate about it, who the winners and losers are going to be, and the market tends to kind of stall just in general. So, any presidential year, kind of in that mid part of the year, we get a little less excited on near-term prospects for the market, and then it builds into after the election. The market tends to do quite well in November and December when you know who's in there, and it doesn't matter really who it is as long as there's a little bit of gridlock and you know what you got. Then people can assess risks, and confidence actually comes back that there won't be dramatic change. Now this year, it's a little different. There's a bit more anxiety because the betting odds are signaling a Democratic sweep. And you see that in these charts. On the upper left, the odds, and these are the betting odds of who's going to win the presidential election. And you can see Biden has a 13-point lead on this part, 57% odds that Biden will win if you look at the betting data. And then on the right, you can see the betting odds suggest that there's a 57% chance that the Democrats take the Senate and then control both the House and the Senate. And anxiety does rise when this happens. And I'm not making a political statement when I say if there's a sweep that could create some volatility, because Wall Street likes gridlock. They like status quo. And sweeps portend policy change, which is not status quo. So it will rattle investors just a bit. And I think that while you see the betting odds suggesting this is happening, you think the market would accept it, I don't think investors have. I think investors still kind of thinking that the Republicans, the GOP, will hold the Senate, and therefore, you'll get gridlock and continued status quo. If the Wall Street group, the investors, come around to the betting odds, I think the market is vulnerable to just a near-term kind of pullback or correction. And if you look at the data on the next set of slides, you can see that if you have gridlock historically with various combinations of who controls the White House and who controls the Senate, those first 4 bars are gridlock type, split leadership type of scenarios. The market's up strong double digit. When you have a Democratic Congress and a Democratic president, you can see that the return of the market tends to be lower. Still positive, still almost double digit, but your returns are a little more somber. So just something to think about on that front. The other point that I think is key in all of this is, whereas investors might be a little pessimistic, a little worried about policy change if we do have a sweep and Biden is our president. And again, this is not a political statement. This is just talking about what the market will worry about. I think it could be more market friendly, that scenario, than people think, just by looking at these, historical data pieces on what happens when one party controls everything. And the reason I say that is that it is true that a President Biden is likely to hike tax rates, both corporate and personal. There are other things that he wants to do that are quite stimulative to the economy near term, and one of them is related to infrastructure. and he's put together thoughts and plans about that, where he would really like to invest in our infrastructure. That would be stimulative to the economy. He also is more likely to be a little more moderate on tariffs and employing tariffs and the impact that that has on our trade. And so the thought is that his tax plan might reduce S&P 500 earnings on something on the order of about 10%, but that would be offset by these other stimulative measures that maybe you get dilution in the low single digits in earnings growth, which is really nominal. It's not that big of a deal. And so while there might be angst there, I think the actual data, and eventually the market trades on the actual data, I think is much more market friendly than Wall Street might speculate once they embrace the news that there could be a sweep here. So I think maybe less to worry about than we do think. The final thing I would say on the election is on this chart that you have up here. And if forget the betting odds. The betting odds, have some view, and they were dead wrong on what would happen to Trump back in 2016. They made a bad call. Really, it's the S&P 500. Watch what it does 3 months before the election. And you can see on this chart that when that blue line is nicely positive and going up, which marks the return of the S&P 500 3 months prior to the election, the incumbent party has won. That's that powder blue line. When the S&P 500 kind of trades flat to down as erratic, the incumbent party has lost. So if the S&P is doing really well, that might pretend that a Trump is back in there. And I do think that it depends upon if the economy continues to improve like it has just in the last quarter, after very bad, a tough end of the first quarter, beginning of the second quarter. We close on a better note. We're going into the third quarter with some momentum. And if the coronavirus cases ebb a bit rather than continue to spread like they are, that will shift these betting odds. It will shift the probability of any kind of a sweep. So we really need to look at the economy and the market, and I think that will portend what happens in terms of sweep or no sweep and who wins the White House. But on the the chart on the right does show you that generally in 1 year after an election, if the incumbent party wins, it generally tends to be better for the market than when the incumbent party loses. And again, it's because of that early angst about policy change that impacts that. Both are positive over time generally, but a better scenario, stronger market, stronger upside when incumbent parties win. So that's enough on the election, I bet, for everybody.
Well, there will certainly be more to come as we will be living election risks until we get to November. So now,
Absolutely.
Jeff, that we've covered a couple of the risk items. You did mention, the thing to watch, especially as we're watching the election risks, is the economy. So let's talk about how about the economic trends and this disconnect that we keep hearing about between the economy and the stock market, with the former falling apart, but the latter being on fire and doing well. Can you help us, just think through that and figure out how to think about that disconnect?
I can. And so we've got some charts to show you what is happening to the economy. But let's first start just talking about the concept, the idea of having this disconnect. And it doesn't bother us that there is a disconnect. It does not bother us that the economy in the first quarter was weakening significantly, and yet the S&P 500, after being very weak in the early part of March and responding to that, all of a sudden turned quickly and advanced and rallied 36%. The stock market always trades in advance of the economy. And this was an unusual economy. It wasn't a structural problem. It wasn't a typical recession that came about by things getting overheated and the Fed hiking rates and putting just an end to a really robust economy because things got too heated, and it just fizzled out on its own accord. this was a forced shutdown to invest in our health. And so we knew, and the market knew, that the data was going to be bad because we needed to do it to, protect ourselves and protect the longer term. But generally what happens is when the market sniffs out that things are horrible, but they're getting less worse or are likely to get less worse and begin trending in better fashion than feared out there, the market sniffs that out and begins to trade in advance of it. And the data doesn't have to be a lovely picture of heaven before the stock market starts to move. And 2009 is another great example of disconnect that has gone on, for quite some time. In 2009, the market bottomed during that housing implosion in March, and we were losing 700,000 jobs a month in March back then. It's a lot of jobs to be losing. The data didn't get much prettier than that. We were losing 600,000 a month still in July, and then 500,000, and then 400,000. We continued to bleed out jobs. It's just that we were bleeding them out at a lower rate. And the market was up almost 27% in 2009 in the midst of that. And it was simply because the market could see, the trend is shifting. The absolutes are horrible. The absolute data still isn't pretty, but the trend is getting less worse. And boy, we're going to finally see stable and positive in 2010. And that's exactly what's going on now. The data that we see out there is getting less worse. And so this first chart is taking a look at the earnings data, looking at expectations for forward earnings. And you can see they came down and down and down and down and down all the way through May. And now in June and July, they're beginning to be revised more positively as we're going back and reopening the economy. And that's what the market could sense and pick out. And it's that trajectory. And that's why it began to rally. And it thinks that line is going to continue to go up as we move through the end of the year and into 2021. And expectations for 2021 are coming up as well. And then if we look at the next set of charts, you can see some other economic data. On the left, we have U.S. unemployment claims. And if you look at that green line, it looks like, Apollo 15 or whatever, taken off from Cape Canaveral. I mean, it just shoots up, and then you can see it comes significantly down. So unemployment claims, falling significantly, still above levels, pre-coronavirus, significantly, but way down. And then you see personal income on the right-hand chart, and that's the green bar. And you can see how personal income, believe it or not, personal income, because of the CARES Act, because unemployment insurance, personal disposable income is higher than pre-coronavirus because of the stimulative measures that the government has taken on. That's to get us through the gap. The yellow line is interesting because that represents the savings rate. And because people could not spend a lot of that personal income that was coming in, they could spend it online, but they couldn't go to restaurants and bars and, go watch baseball and stuff like that. So they saved a ton of that extra personal income, and that will help us get through this Q3 gap. As we reopen, there's a stash of cash that is out there for future spending. And that's a positive thing. So that's part of what the market's sniffing out. If you look at the next set of charts on the next page, here we're looking at retail sales. They fell off a cliff, and now they're getting less worse. They were up something like 17% in the month of June, off of a very low base, but they were up significantly. So it's that percentage change from where they were that, month over month that matters, that transition. On the right-hand side, we see the U.S. Institute Supply Management Report talking about manufacturing activity and non-manufacturing or service level activity. And you see the black bar at the 50 line when the green and the blue lines that capture, the blue being manufacturing, the green capturing service activity, those sectors of the economy, how they're doing. Anything above 50 means that we're growing again. So we've fallen well below 50, and now within the last month, we've nicely moved back above 50 into growth mode. We need to see that sustained, but that's a very nice trend, and that's what the market sniffs out. And we could go on and on. Other data on the next page hits housing. You see the trend, not a thing of beauty, but trending in the right direction. Stabilization in industrial production after having fallen, starting to pick back up. And then non-traditional data on the next set of slides, looking at things like the open table reservations. You can see that we were in swift decline, and now much less so. More people are eating out. The TSA checkpoints, looking at the volume of activity, we're still down, close to 80% year over year, but we have 4 times the amount of people traveling this month than we did last month. So things are getting less worse, and that's what the economy likes to see. I will tell you.
Those are all. Sorry, Jeff.
That's okay. I get carried away. The only other thing I wanted to say to you was that, historically, Katrina, the U.S. economy bottoms about 4 months ahead of, or I should say, the better way to look at this is the stock market bottoms 4 months ahead of where the economy actually does. It begins to move in advance of where the economy bottoms because it senses that it's going to do that. The range is 3 to 11 months. So it moves ahead on average of four months where the economy does, but the range is 3 to 11 months. So this disconnect, it's part of history. That's just what happens.
Yeah, no, that all makes sense, and I do think that's helpful to kind of put it in context with why we're seeing some of the data not necessarily matching what we're seeing in the market, and those are all great points to highlight and bring forth to the listeners. So I know you like to highlight that we look at fundamentals, valuation levels, and technicals when we're assessing the market. And so any thoughts on technical price trend data that might be relevant for our clients to hear?
Yeah, I think so. And one of you started, your comments by talking about avoiding whiplash. And so this slide right here just brings to life the whiplash that you could have suffered if in, call it March, you see where the blue line, which marks the price trend in the S&P 500, where it significantly just fell, and it looked like there was no gravity to catch it. And then equally swiftly, it moved up. And so I just wanted to show this, and we couple with that the number of stocks advancing versus declining in that, in that red line. It also rolled over just a bit, but the trend, the long-term trend, would remain pretty positive. It's not like it was in complete free fall. So I think some of the technical data that we saw out there, oversold conditions with decent fundamentals and yet long-term price trends staying pretty much intact, that did help keep us and give us conviction to stay invested and say, hold your ground. And, just prevent us from allowing clients to mistake activity for progress. It might have felt good if you would have sold back then because all the news was negative, and boy, in the ensuing rally, you would have just felt awful. So some of this, following this technical data can really help. And I don't want to actually get any more technical than maybe that. There are a lot of things that we look at on this front: sentiment, momentum, breadth, all kinds of things. But I think this chart is a pretty good summary. And the next one, I think, says quite a bit as to why we have a split kind of rating on the market near term versus longer term. And so this captures the last 10 significant corrections that we saw in the market with follow-on rallies. And this is tracking recovery rallies, first phase recovery rallies, the first 65 days of those recovery rallies following steep declines in the S&P 500. And you see all these various dates. You know, when you see a 1987 in there and a 2009, you know, a lot of these dates would just ring true with people who might have memory of significant sell-offs. But you can see the first phase, the first 65 day recovery rally percentage changes, and in the blue box is the recovery rally that we've seen in the most recent advance that we've experienced. The market's up 36.3% off of that low that was set March 23, which is pretty significant. It's the third strongest first phase recovery rally. You see the other two very strong ones, 2009 and 1982, where you had 38% advances in the first 65 days. And the question is, well, what happened in these historical periods of time when the market really advanced nicely pretty quickly off of, you know, weakness? And we look out 20 days, which is a month of trading. We look out, you know, 3 months worth of trading, and then 6 and 12 months worth of trading. 250 days is 12 months worth of trading. And you can see that in the first month or so after that kind of recovery rally, the market on average was down 1.8% if you look at these historical times, and only positive 20% of the time. So that's part of our caution, you know, just on the near term with regard to getting all Twitter about, oh, let's buy on the dips. But man, when you look out 6 months, when you look out 125 and 250 days, generally in these environments where you've had nice swift recoveries, it portends well for the longer term. So again, this is just part of the technical stuff that we look at, and one of the reasons why we're cautious near term, but we feel very confident when looking out over the longer term.
Thanks, Jeff. That's helpful. This next slide, I know we've got the wall of worry to cover, and then I think just a couple more slides. So why don't I just turn it back over to you to do a quick wrap up on these next three?
Sure. So quickly, just on the wall of worry, you know, no doubt we're not out of the woods. There's going to be a lot of negative headlines as the market climbs this wall of worry. And so I think the ones that are cited most often are, you know, what's going on with the second wave? Are we going to be able to manage that? And we get data now all the time on hospitalization rates, new cases by geography, and we'll continue to watch that. How about stimulus? We've had a lot. Will we continue? We do think that we'll get another spending bill of over $1 trillion. That will be a positive. Let's watch the news flow on that, but that would be our expectation. We've talked about the election, and I guess to frame that up, we do think that the odds of there being a sweep is rising. We think that the threat from a policy standpoint may be to Wall Street may be less concerning than is appreciated. So you could get a bit of a correction or pullback as people sweat about the rising odds of a sweep, and yet we think the lasting impact will not be significantly negative. U.S.-China, the trade feud, you know, seems to kind of continue, and yet there's reason to think that you just won't have complete implosion, you know, on that front. We'll continue to watch it. These other things are higher on the Richter scale, if you will. The big things, though, where you get all these headlines, you got to understand them. Here's what we worry about. It's everything on the right-hand side. We're going to be looking at the continued trend in the economic data. And what we want to see is a swoosh. We don't think a V is likely, but we do think that you'll get gradual recovery in traditional and non-traditional economic data and earnings, and that's what our base case is based on. So we'll continue to watch those things. And then some of the other fundamentals that we're watching that maybe are less on the front and center that people talk about: credit spreads. How's the credit market doing? We don't want to see the bond market, advertise stress out there. Right now, we don't see that. Spreads came back in. They've backed up and retrenched just a little bit, but still in a healthy range. Commodity prices are sending signals that we'll have to see if this is a head fake, but copper's up 30% in the last 3 months. Zinc and aluminum, all these commodity prices are up. What that may tell us a little bit is, how does domestic versus emerging markets look? And how do the more cyclical areas of the US stock market look? And if commodity prices continue to trend well, the dollar continues to weaken, which is good for commodity prices. That could portend a bit of a recovery in international versus domestic. We're watching that. We're not ready to just totally bite that, but we're looking at that. And then leadership within the equities, growth versus value, that type of thing. Is it the riskier areas of the market that are doing well? That would suggest longer term results. We might be taking up our S&P 500 targets if you begin to see more rotation into riskier types of stocks. That would signal confidence. The next slide gets into the risk of market timing. I just throw that out here for those that think you can get really cute. And Jeff, if you're cautious near term, why wouldn't you trim? And then you get back in and all that kind of stuff. The reason we're kind of hold your ground, this is one of the reasons why we're hold your ground. If you want to be negative and you see nothing but negative and there's no stimulus, all the economic data is going the wrong way, the election is definitely a sweep, and that's going to mean dramatic policy change, and all those things are blowing up, and coronavirus just looks to be horrible, then it's okay to get negative and maybe raise a little bit of cash. But unless you really see that negative data and you're just thinking you have a little bit of softness and over the next 12 months the market's up, there's not a lot to do. This shows you if you miss just the 20 best days in the market over the last 25 years, your annualized return would have fallen dramatically than if you would have been fully invested the whole time. In fact, your return would have fallen from 7.8% a year to 2.4% a year. If you miss the 30 best, you're almost flat the 40 best over that 25-year time period. You actually lose money as opposed to make 7.8% a year. So it doesn't pay to be negative in the market unless the data really takes you there. That's the point, the difficulty of market timing. So to wrap up, Katrina, these are the final bullet points that I would say just kind of set the tone for what we're thinking. We're cautious near term on equities, and we wouldn't be surprised to see any of these wall of worry items that we've mentioned cause a temporary pullback in U.S. equities. But we do think that a market bottom is in, that we've seen the bottom that happened back there in March, and we don't think that we'll break below that, even if we get some kind of pullback, wall of worry pullback. Our 12-month target's 3,500 on the S&P 500, which is nice double-digit advance in here, and we could actually take that up if second wave concerns subside and or a vaccine is introduced. The amount of this additional upside in the market will be influenced by the shape of the recovery, and our target is based upon a gradual swoosh, not a V-shaped recovery, and factors could make it better than that or worse than that. And we can adjust our targets based upon that. If COVID spreads tremendously and we don't get stimulus package and other economic data begins to roll over, we'll let you know and adjust. But right now we see that nice double-digit kind of return and the data going the other way. One of the surprises to us is the strength and sustainability of this existing rally. We may not get a near-term pullback or correction before going to that 3,500 target. We might be wrong on that in terms of our caution kind of over the next couple months. And we're fine with that because our clients already have significant equity exposure. And if we're wrong, they're going to benefit nicely. We just think that at this point in time, with uncertainty over the next several months as we're reopening here, that a little focus on risk management is the better side of valor than greed and an immediate buying or dips. Oh my, this fear of missing out, like FOMO, we're trying to keep in check. And hence it's this hold your ground view. And the final point would be, if you press me to say, what do you like more? We would say right now, we would still favor domestic equities over international equities. Within domestic, we would favor large cap equities over small cap still for now. At this point, some people are saying, oh, you should be all growth or you should be all value. We think a blend of growth and value and a balance between growth and value equities in the US makes a whole lot of sense. And if pressed on international, we would favor developed over emerging. Some trends that we do like this that we're seeing is a weakening dollar and strengthening commodity prices, and that could make us adjust some of these views on domestic versus international, but at present we think it's premature to do that. And that kind of locks it down. That's a lot of stuff, Katrina.
That was a lot of stuff, but it was good stuff. As always, enjoy hearing your latest thoughts and views and things for us to be thinking about as we are moving forward. So thank you for providing your latest strategic thinking and the narrative on the market. We hope to our clients, we hope that you're all staying safe and healthy, and we hope this has been helpful to listen in, and we look forward to continuing to provide you with updates in the future, because needless to say, there is never a dull moment in the market. Thank you.
Thanks, Katrina.